What is the ideal debt to equity ratio? Is there a secret number? As a retail investor, I have always tried to find answers to these questions. And that is mainly because the debt to equity ratio is a very easy way to assess the riskiness of a company. And retail investors do not need to take unnecessary risks. Companies like JP Power and Reliance Communications are penny stocks now, mainly because of debt. JP Power, after restructuring its debt, became a turnaround company and is now doing really well, almost giving multi-bagger-like returns. That's how important debt management is. Now, before we get into the details of debt and equity, let me share one little fact with you. It is widely accepted that companies with higher debt to equity ratios are riskier investments than companies with lower debt to equity ratios. In most cases, that is true, but there may be exceptions to that. For example, Tata Power has a debt to equity ratio of 1.74. While for Adani Enterprises, this number is 1.56. Does that mean Tata Power is riskier than Adani Enterprises? There is only one way to find out. By understanding the concept of debt, the types of debt, and the dangers of debt. And by the end of this video, you will get a clear idea of the ideal debt to equity ratio. And along with that, I will also share a trick to very easily check the riskiness of a company. So without wasting any time, let's get started. Debt is obviously something which cannot be taken lightly because it has destroyed a lot of companies. In very simple terms, we can say that debt is the measure of a company's financial risk. It is a liability on the balance sheet which can lead to bankruptcy. But still, taking debt sometimes becomes necessary. Let's understand the basics of debt and equity with a very simple example. Let's say I want to start a business. The step 1 is to buy assets like plant, machinery and equipment. The estimate says a capital of 1 crore is required. But I have only 50 lakhs with me. So I have two options to raise the other 50 lakhs. I can either take a loan for which I would have to pay interests regularly, even if I don't make any profits. This is debt funding. The second option is to sell a part of the company in the form of shares and get the money. This is equity funding. Now, if I decide not to take any debt and do only equity funding, the debt to equity ratio will be 0, but I would have to liquidate too much of my company. What if 10 years in the future, the company grows really big and starts making huge profits? I will not have much ownership in it, even as a founder. And that is because I did too much equity funding. Now in the opposite scenario, I can choose to do only debt funding so that when the company grows really big in the future, I can have all the ownership. But for that, the interest payments will be really high and it could take away all the profits. And if I fail to make the interest payments due to lack of profits, my company can even get taken over. So here are the main differences between the two funding methods. Debt investors in a company enjoy a fixed rate of return. Equity investors do not enjoy a fixed rate of return. The returns that we equity investors make can be a few hundred times our investments, or it can also be 0 and even loss of our capital. All depends on the performance of the company. Debt investors are just lenders to the company. Equity investors are owners of the company. Equity investors can participate in the management of the company. We can vote and elect our representatives to work in the board for protecting our interests. Debt investors have no role to play in the management. Now that the basics of debt and equity are clear, let's understand the types of debt. Short-term debt is the money that the company has to pay back within the year. Usually it is cheaper to borrow short-term money than long-term money. So to make profits, what companies can do is borrow short-term money and lend it for long-term at higher interest rates. And to pay back its own short-term debt, the company can borrow even more short-term money. In the world of corporate finance, this trick is called rolling over the debt or debt refinancing. Another thing that companies do to take advantage of cheap short-term debt is that they buy long-term assets like buildings, plant and machinery with short-term debt. Now these two tricks are dangerous because of two reasons. Firstly, they create a mismatch between long-term assets and short-term liabilities. And secondly, they create cash flow problems. These tricks work well until the interest rates are favorable. I'm sure you must have heard of the repo rate. The repo rate is a repurchase agreement which is basically the short-term interest rates. When inflation goes up, the Reserve Bank immediately raises the repo rate. This creates trouble for companies which require a lot of short-term debt for refinancing. Let me explain with an example. Suppose the short-term rate is 5%. A very smart company borrows at 5% and lends it out for the long term at 7.5%. That's easy profits. But what happens when the Reserve Bank raises the short-term interest rates to 8%? This company has to borrow at 8% to refinance its own short-term debt which it borrowed at 5%. And it cannot rely on the interest payments it's going to receive for the long-term loans it gave at 7.5%. This is going to be a disaster. And this is exactly how companies go bankrupt and shut down during times of high interest rates. Another danger of short-term debt is not finding lenders. If a company needs short-term money to pay off its debts and the lenders suddenly refuse to lend more money, the company may have to shut down. In times of economic slowdowns, credit is not easily available. That explains why so many companies go bankrupt during times of recessions. So this is why the safest way to make money is to borrow long-term debt and lend it for the long term. And that is exactly what the core business of the banks is. They always want us to invest into their fixed deposits, which means they are trying to borrow long term. It is the debt that matures anytime beyond 1 year. Great businesses usually do not require a lot of long-term debt to expand. They can generate enough cash flows from their operations to carry out expansions. If a company has a history of 10 years of operations with little or no long-term debt, that means the business is great and the company has a competitive advantage. What about those companies which started their businesses with a lot of long-term debt? Can they be great businesses? Well, if they have enough earnings power, they can pay off all their debt within 5 years. That is also a sign of a great business and a competitive advantage. There is another situation in which a great company can have a lot of long-term debt on its balance sheet. It's when it acquires a bankrupt company. This is a case what Peter Lynch calls diversification in his book One Up on Wall Street. I highly recommend retail investors to read that book. Now let's have a look at the debt to equity ratios of various sectors to have an idea. So here is the debt to equity ratio of various companies from the power sector. As you can see, the median debt to equity ratio is 1.27. So Adani Green has a debt to equity ratio of 7.23, which is almost 6 times the median for the sector. Tata Power's debt to equity ratio is 1.74, which is above the median, but the company is doing really well. Adani Power on the other hand has a debt to equity ratio of only 0.8, which is much lower than the industry average. But that does not guarantee that Adani Power is a less risky investment than Tata Power. It all depends on the cash flow generations and how easily they can pay off their debts. So this is the auto sector, and here are some of the well-known companies from that sector. As you can see, the median debt to equity ratio for this sector is 1.65. Tata Motors, which is the leader of the EV sector as of now, has a very high debt to equity ratio of 2.38. It is way above the industry median. Truck making company Ashok Leyland has a debt to equity ratio of 3.87. Now one of the companies in which I am heavily invested is Olectra Greentech, and its debt to equity ratio is only 0.15 even after operating in an industry which requires companies to take on very heavy debt. This is the reason why Olectra Greentech has a competitive advantage, and the risk level is extremely low here. And without any surprise, the company has already been a multi-bagger. So here are some of the well-known companies from the FMCG sector. As you can see, the median debt to equity ratio for this sector is only 0.01. Hindustan Unilever 0.03 debt to equity ratio. Procter & Gamble Hygiene has literally zero debt. So companies from the FMCG sector are capable of operating without taking on any debt. But that may not mean that FMCG companies face no risk. And there are a lot of factors other than debt which can create financial troubles for the company. Now let's have a look at the banking industry. So here is a list of the major banks of India. As you can see, the debt to equity ratio for the banking sector is extremely high. The industry median is 7.42. Now this actually does not denote the riskiness. It actually tells us about the nature of the business of the banks. The core business of the banks is to borrow money from people and lend that money at higher interest rates. This is the reason why banks have an extremely high debt, and it would not be prudent to judge a bank based on the level of their debt. So now it's quite clear that the debt to equity ratio can vary from sector to sector. But there is one very important thing that retail investors need to understand is that whenever the debt to equity ratio of a company is negative, it means the liabilities exceed the assets. It's a very risky situation and could lead to bankruptcy. Debt to equity ratio alone cannot decide the riskiness of a company. Risk comes from the very nature of businesses and also from the business decisions made by the management. For example, DMart has an extremely low debt to equity ratio of 0.04. Their strategy is to grow slowly and responsibly without taking any debt. This could create a different kind of risk. What if a competitor like Reliance decides to expand really fast by taking a lot of debt? They could capture all the markets even before DMart reaches there. So we are all equity investors. What is the point of studying debt in such details? Well, stocks give us part ownership of a company, and that ownership also includes the debt that the company carries on its balance sheet. Now here is a simple trick that retail investors can use along with the debt to equity ratio to assess the riskiness of a company. Just have a look at the current ratio, which is arrived at by dividing the current assets by the current liabilities. A current ratio of above 1 with a low debt to equity ratio should be safe enough. If you learned anything valuable from this video, please like and share. And if you don't want to miss future videos like this one, click on subscribe. Thank you very much for joining, and I'll see you in the next one. Jai Hind.